You are listening to Charting Wealth's comprehensive weekly review and forecast for the week beginning Monday, the 12th of December, 2016. Markets are up. In fact, we've got our fifth week of straight up movement. As far as our weekly charts go, we crossed over going up back on the 25th, the week ending the 25th of November. And we actually saw the markets turn around and start moving up that week of the election of President-elect Donald Trump, and markets continue to be booming. This is the second biggest week that we have had according to our candlesticks as we look at our Heiken Ashi charts. We have both our two-day and our weekly chart in strong up movements. Those of you who follow us on a daily basis, and there's no reason not to, we only ask 10 minutes of your time and are filling out your daily market worksheets. Go ahead and mark the weekly trend as up on IYY, which is the Total Market Index Fund. Now, this is the way we do it. We ask you to every day spend 10 minutes with us. Simply chart these markets. We cover the total market, the S&P 500, the NASDAQ 100, and gold. We ask you to practice with us. We're not a stock calling service. We are an education firm, and we want you to learn how to read these charts. Once you learn to read charts, then the world's your oyster. You can make as much money as you want if you learn this. Spend 10 minutes a day. It's the most important 10 minutes as far as your financial freedom and wealth goes that you can put in. And just like anything else, if you practice, if you try long enough, you will master it. How long will it take? I can't tell you. It depends on how adept you are at doing this, how dedicated you are. But just mark out 10 minutes a day, 5 days a week to do this. It's a little bit longer for the comprehensive review, maybe 15 minutes over the weekend. Can't you find 10 minutes in your day to give yourself the kind of retirement choice and freedom you want? Yes, you can. So stay with us, be with us. Now let's keep moving through this. We see that we've got an up chart on the weekly chart, crossed over going up back on the week ending the 25th of November. Now let's look at what happened on our two-day chart. We see that our two-day chart crossed over going up back on the 10th of November, and but for a break on the two-day chart ending the 30th of November and the 2nd of December, it started right back up again. We've got a nice two-day trend line, and we see over the course of the past week that the market continued to move up. Three strong up candles. The first up candle ending on Tuesday the 6th was not that strong, but the market continued to fly up. Actually, the last two-day candle ending on the 9th, wrapping up the week, was a strong up movement. Market's up 0.49% on Friday. We see that PPO, the old moving average convergence divergence indicator, now we use the PPO, the price percent oscillator, because it uses a percent instead of just a dollar, and we like that better, and so we follow that now. We can compare it across the board a little easier when we're not dealing with dollars, but we're dealing with just percentages, and we see that it's kinked up, continues to move up and away from the signal line, and we see that our derivative oscillator actually gained a little bit of energy toward the end of the week. Now let's look intraday. So every day we'll have two candles, and we can see that as the week got started on the 5th of December, we saw that the market continued to move up, swung sideways for about a day and a half, and then started taking off on the afternoon of the 6th. And what we saw happen there is that the market continued to move up after Tuesday, moving up very, very strongly the afternoon of Wednesday and then Thursday on into Friday. And again, we had that crossover going up. We warned you about that, told you that might be coming if it was, to be ready to get in. Those of you who did listen, you have done well so far, Padawan. So again, continue to follow what we teach. If you don't know what it is we teach, hey, we've got a free 15-minute how to read a stock chart video that you need to get. How do you get it? You sign up for our newsletter at chartingwealth.com. Easy to do. It's on the first page of the website, and for free you'll get this comprehensive review once a week plus our daily forecasts. So that and our daily reviews. That's where we are as far as the total market goes. Now let's drop back to our weekly chart. And we're going to the S&P 500 up 0.60% for the day. When we look at what our chart looks like, we see that there is a crossover that occurred about the same time we saw in the total market on the 25th, the week ending the 25th of November. Market turned around. That election week started moving up. S&P 500 still strong up movement. One of the strongest weeks on our Heikin Ashi charts was the last week. We saw the derivative oscillator gain massive energy. We saw the PPO kink upwards over the course of that week as compared to the prior week where it was going flat. So again, markets continue to build as the Christmas effect is in full swing. Do mark your charts for your weekly trend. It is up, as is your 2-day. The 2-day's also up, of course, on your total market. Let's look at the 2-day chart, see what we see. We see the 2-day candle ending on Tuesday the 12th. Again, after some backsliding at the end of the prior week, that last candle on the Friday the 2nd, we see that the entire week was up. Weakest was the beginning of the week, Monday and Tuesday, then Wednesday, Thursday, and Friday, strong up days. 2-day chart is in a confirmed uptrend also, moving even higher. Derivative oscillator gained energy on the last day of the week. And of course, if we look at our half-day chart or 4-hour chart, what do we see? We told you what to look for when we had the crossover going up right there on the afternoon of Wednesday. Those of you who jumped in have done well. Markets continued to climb. This is what we look for. We look for trend following. That's it. It's truly this simple. For those of you who are new to it, those of you who aren't, here's what we look for. We look for our weekly chart to be going in one direction, same direction as our 2-day chart. Remember, all things being equal, the charts tend to move in the direction of the largest chart until that changes. Okay, that's an up movement. 2-day chart was in an up movement. What were we waiting for? Well, how do you jump in when everything starts flying up? It's hard to do. You have to wait for a pullback. What is a pullback? That's a move in the opposite direction of your 2 big charts. That happened starting back on the 29th, actually the afternoon of the 28th. That was Monday, the 28th of November. What happened? Well, the market sort of pulled back. I mean, it slowed down and went down. Then it turned around and started moving up. When the energy reached a certain point and we saw a crossover of the PPO, the price percent oscillator, over the red signal line, that told us that the short chart was moving again in the same direction as the 2 bigger charts, the 2-day and the weekly. So that's our getting in point. And we got in. Got in that afternoon. That was the afternoon to get in. We told you to watch for it. And when it happened, those of you who were listening, who were paying attention, looked for it, for the inflection point to cross over, and you jumped in. And guess what happened? You've ridden this up movement. Does it always work? No. Does it work most of the time? Yes. Are there times that even when it's working, we don't do it? Yes. And as you practice, as you do virtual trades, like we talk about setting up a virtual trading account at any of the online brokers and start experimenting, practicing with us, filling out your daily market worksheets, jumping in and out of the market on your virtual trades, which is just like a real trade, except you're not winning or losing money, but you are keeping up with how successful you are. You then start to learn how this really works. You can take all the courses you want. You can pay tens of thousands of dollars and you can spend hours every day. Nothing beats the 10 minutes a day with us to practice day in, day out, a little bit every day. And you, my friends, will get good at this. This is the only way to do it. There are no shortcuts to practice. How do you get to Carnegie Hall? Practice. That's what you got to do. Wear your Carnegie Hall. Practice with us every day, and you will find yourself there. Okay, now let's go back to our 2-day chart, and we're going to go to our last index, which is, we want to go to our weekly chart. Our last index, which is the NASDAQ 100, as represented by Q. What do we see going on here? Schizophrenia. We have our weekly chart is in a confirmed down move. Okay? What's going on with the Qs? It's really slipping sideways as we look at our weekly chart. It popped up and reached its last high somewhere back, oh gosh, in October, and then dropped in November around the 4th, and then sort of started gaining energy. But then the last week, the week ending the 2nd of December, was a real iffy week where we basically had what we call a doji, lots of indecision. So we're still in a confirmed move on our weekly chart, but our 2-day chart's in an up move. Now, when we tell you that all things being equal, the market tends to move in the direction of the largest chart, the weekly chart, but your 2-day chart is going up while the weekly's going down, what is that? That's schizophrenia. That's not what we like. We don't want to try to jump into a trade when we don't have both our charts going in the directions we want. So we did have the last 2 weeks were up weeks, but they weren't up weeks big enough to move that weekly chart around. So we're still in a downtrend on the biggest chart. That's the weekly. The 2-day chart, we're in an uptrend. And if we look at our 4-hour chart, we see that that 4-hour chart is building. It has blown through the downtrend in the trend line on the weekly chart, but not enough to pull the weekly chart over. So what do we do here when we have all these mixed signals? Nothing. You don't ever have to do anything. So when the charts don't give you clean trades, you don't trade at all. Because the first rule that we have is you don't lose money. You don't do stupid things and lose money when it's so much easier to wait and make money. So, lesson, keep that in mind. Now, that's where we are on the Qs. We're waiting for the weekly chart to rotate over into the same direction as the 2-day. Whichever way that might be, the market might turn back over and the 2-day go down. Then we have a pullback going up on the half-day chart. And then when it rotates over in the same direction as both the charts, then we can get in. But we don't have that right now. So we're doing nothing with the Qs. Let's go back to mark your daily market worksheets. Weekly chart down, 2-day chart up. Now on gold. Oh, and for the record, the Qs was up on Friday, 0.78%. Gold down on Friday, 1.04%. Strong down. Weekly is down, has been down since it crossed over going down back on November the 14th. So forgive me, I'm looking at the 2-day chart. Go ahead and mark that 2-day chart's down. The weekly has actually been going down way before that. It crossed over going down back on the week ending the 12th of August. Really slid sideways for a while, then dropped off 2 separate times, the last time the strongest. So our 2-day and our weekly confirm down moves. Now let's look at the 4-hour and see what it's been doing. 4-hour chart is so confusing, just like happened last year. You hear me say this about every day. At the end of last year, 2015, after our 4-hour chart had been our total chart for gold, it was beautiful. When the 4-hour chart rotated over going down, it was almost like clockwork. You could count the money in the bank in an inverse trade because the market went down. When it crossed over going up, it was beautiful. Everything turned around, gold started going up. You only needed the 4-hour chart. But then, right like it did last year, the 4-hour chart started betraying us. It stopped working, and it hasn't worked to date. So we will continue to just see what we're going to have to really have happen with gold is going to have to start strongly moving in one direction or another. These half-hearted moves make the PPO not work very well. It is an oscillator, and it does not work well unless you have a trending market. And gold, just like the end of last year, the end of this year, it's really trending sideways too much for our 4-hour chart to work. Now again, and it keeps trying to find its bottom. It looks like its bottom somewhere around 110, something like that. And that's sort of where it's hitting. Now, if it bounds up off that, rotates the weekly and the daily over, maybe we can find something. Or if it starts to plunge, if indeed it crosses over going down on the MACD, you can again practice an inverse gold trade. You can find an inverse fund in gold. If you haven't listened to our training, Inverse ETFs, How to Make Money When Markets Crash, you need to listen to that. You can find it at the website, at our iTunes, and our YouTube channel. So that'll give you a better idea as to how to make money when the market's moving in the opposite direction of any of our indexes or gold. But folks, that's where we are as we end the week on all 4 of the ETFs that we follow and ask you to practice with us. Now let's jump into the news. This is the only time we actually look at the news. We tell you constantly, look at the charts. Don't be fooled by the media noise. As they say on the street, you buy on the rumor, you sell on the news. Well, guess what? You're not on Wall Street. You don't even know what the rumor is. By the time you hear the news, the trade's probably gone. That's why we watch the charts. That's what gives us the advantage over sitting there all day long listening to CNBC or Bloomberg or Fox Business trying to figure out what's happening. We can see it in the charts. But let's talk about what happened in the news. We saw that global stocks continued posting strong gains over the course of this last week as investors moved out of defensive asset classes. And guess what? They started taking on more risk. We've seen the strongest pockets in the U.S. market since the election have been things like industrials, energy, financials, materials, and technology. And the bond sector, particularly high-yield bond spreads, have been compressed, with most sectors sitting somewhere around their 52-week lows. What does that tell us? Well, it indicates that our investors are seeking yield opportunities, which they're seeing in the markets as things go up. You're not seeing it in gold, but you are seeing it in the markets, particularly in the S&P 500. You are seeing it some in the Qs, but we've got whole sorts of other things going on there, which makes it hard. But we only need one index to be working for us, actually to the total market and the S&P 500, in order to make money. We don't want to be in more than one investment trade at a time that we can actually follow. So again, we don't want to get ourselves confused and overload the information. Everything we do here is to keep it simple. We follow Occam's razor. We keep it as simple as we possibly can. That's why our charts are so simple. And folks, that's why they work so well. So what's going on in Europe? Well, the European Central Bank has decided they're going to extend quantitative easing all the way through December of next year. But they're going to reduce their monthly purchases from 80 billion to 60 billion euros. What's quantitative easing? I love it. It's basically printing money backed by nothing. Fiat currency to the max. What's going to happen in the end? Well, what always happens when you went with fiat currencies? They inflate out of control. That'll happen. Who knows how long it'll be, but that's what's happening right now. They're just going to continue printing money backed by nothing. But the Eurozone economy has improved in recent months, but they fell short of their expectations over the last week. Where did it fall short? Well, German industrial production came up short, and UK manufacturing output unexpectedly fell almost 1% in October. That wasn't expected. Then what happened in Italy? Well, we saw the Italian voters reject the referendum on giving more power to the European Parliament and, well, to the entire Eurozone. So that was just Italy, though. They did have their prime minister resign as he promised, and the anti-establishment trend that, of course, started in the UK with Brexit and we saw in the United States with Trump's election has continued, although we didn't see that happen in the Austrian runoff. The Austrians voted against the anti-establishment trend. So again, nothing too surprising there. What is interesting, though, is the debt for Italy is currently rated just 2 notches above junk status. So we'll see how crazy it gets in Italy. I was just in Italy a few weeks ago, and what a lovely place. Maybe their government's all screwed up, but the food sure is good. What does that have to do with investing? Nothing. But we will just continue to watch the madness. What will eventually happen? Oh, I think the euro's just going to go down. It'll take a while. Germany will keep trying to hold on to things, but all the other countries will implode until the Germans at some point probably figure they've got to get the hell out. What's happening in China? Well, China trade data surprised analysts actually on the upside as imports and exports to China increased sharply in November. Imports suggest that there's stronger domestic demand, while the rise in exports show that maybe global demand is strengthening. We'll just have to continue to watch and see. But despite these increases, things aren't all that rosy in China. Their import and exports remain negative for the year through the month of November, and yuan has actually fallen 3% versus the dollar, and that's happened just since October. So while China's foreign exchange reserves fell to their lowest level since March of 2011, things aren't all that rosy. Now, this past week, not a whole lot of market moving news, but let's go on to what our forecast is going to be and what we're going to see potentially happen over the course of this next week. Now, of course, we're going to follow the charts to tell us exactly what's going on. Right now, confirmed up moves on our total market, on the S&P 500, and of course, we can't make any calls on the NASDAQ 100 because it is schizophrenic. We've got the weekly chart down, the 2-day chart up. Gold going down, continuing to move down strongly. What can affect the market over the course of this next week? Well, China's industrial production report is going to be out on Monday. But what's the big market moving news? That's going to be on Tuesday and Wednesday. And that is the 14th and the 15th. And the Federal Reserve, the Federal Open Market Committee, is going to meet. What are they expected to do? Improve maybe a 1/4 point rate increase. We'll see. If they do something crazy, it might really affect the markets. What do you do when you're in a good trade and the Federal Reserve is meeting? Take your profits and wait. Take your profits, get out, watch and see just what's happening, because we can't make a call on what the Federal Reserve may or may not do. Markets may give you some idea, but they may also pull the rug right out from underneath you. On Wednesday, remember the Federal Reserve is going to be meeting through Wednesday. You're going to have the Eurozone industrial production figures are going to come out. Also on Wednesday, U.S. business inventory, industrial production data, and retail sales. Wednesday may prove to be a huge day. So pay attention, watch what's going on, be very careful. And again, you're all going to be doing, hopefully you're in right now, your trade that you jumped in probably in the S&P 500 with it moving up. So again, watch that. As we go into the market on Tuesday, as the Federal Reserve starts meeting, be very careful. You may very well want to pull yourself out at the end of the day, either on Monday or Tuesday, depending on what the charts are telling you. If they look like they're peaking out and all, take your profit. Take your profit and enjoy it. But just be careful that as you go through, particularly Wednesday, with all the things that are going to be coming out, inventory, industrial production, retail sales in the States, along with the Eurozone's industrial production, and the wrapping up of the FOMC, be very careful. Then at the end of the week, we're going to see on Thursday, the U.S. Consumer Price Index. There's also going to be the National Association of Home Builders Market Index is going to pop out, along with jobless claims. A lot of stuff getting in before the Christmas break. So be careful, watch, listen, learn, pay attention. Those of you who haven't been through a Fed meeting before, just watch it. Be careful. See how the market reacts. It many times is very surprising. Folks, that's where we are as we wrap up the week and go into the new week on Monday, the 12th of December. Hope that you're planning, getting your gifts, making sure you keep all your family and friends happy as we go through the Christmas season. Wish you the best at this busy time of year. Remember, 10 minutes a day is all we ask. You have questions, problems, concerns, let us hear from you at chartingwealth.com. If you're not already signed up for our newsletter, you need it. You get this comprehensive report once a week, plus you get our daily stock, market, and chart reviews. And you can get all that at chartingwealth.com for free, plus all of our trainings downloaded there. We love to hear from you. Tell us what your problems, concerns are. If you want to help us out, go subscribe to us on iTunes. Give us a 5-star rating. We would so appreciate that. You guys have made us as high as number 6 in the world with stock market podcasts, and we so appreciate that. Also, go to our YouTube channel and subscribe. It's one of the first places we put all the information we put out, our training, our comprehensive reviews, and our daily reviews. Thank you so much. God bless from chartingwealth.com.